Welcome to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, stock market's technicals, and market internals, things like breadth and sentiment, to try to figure out where the market could be headed over the near term. This week, we're seeing the partial federal U.S. government shutdown continue. It now is the longest shutdown in history, and there's no end in sight. And there are concerns that this extended closure is now taking a much larger bite out of the economy and leading to other disruptions, things like the disruption in travel that you're seeing. And that is causing an increase, an uptick in stock market volatility. So the S&P 500 is off by about 2.4%. From the highs made at the end of October. The NASDAQ lost 3% last week. That is its worst weekly showing since April. And this increase in volatility also featured a rare test of the 50-day moving average by the S&P 500. So, and you can see the S&P coming off the early April lows and the sell-off around the initial trade war headlines back in May, recovering back above the 50-day moving average, which is this black line. And you can see really until recently has come nowhere close to even testing the 50-day. We had a couple tests back in October, and then we had one instance where this past Friday, where price on an intraday basis undercut the 50-day. But speculation over a deal to reopen the government pushed the S&P back higher, and we had another close above the 50-day. That marks, as of the end of last week, 133 trading sessions in which the S&P has now closed above its 50-day moving average. So, we're seeing this impact of the government shutdown and speculation over how long it's going to last. That's driving the headlines. But when you look beyond those headlines into other things, private sector data. So remember, there's a lot of government reports on the economy that aren't coming out while this shutdown is in effect, but we've got private sector data pointing to an economic backdrop that's still holding up, and that supports the earnings outlook. We have the ADP report on private sector payrolls. It showed the addition of 42,000 jobs in October. That was better than expected, and reversed September's loss. You can see September's loss of 29,000 jobs. So you see, job growth weakening throughout the year as all the trade war headlines made the rounds. But look, jobs data is among the last to respond to changes in the economy. And what you could be seeing is we had this deceleration into the summer months around the trade war. Now that we're seeing some of that fall clear, you could see job growth pick back up, and maybe October was a hint at things to come. Now, there's other reports covering activity in the manufacturing and services sector that are showing improvements in leading indicators. So, for instance, we had a report from the ISM that showed service sector activity expanding in October. What you want to do is pay attention to some of these underlying components, like the new orders component. It rose to 56.4 in October's report, and a reading above 50 indicates expanding activity, and that new orders component, again, is a leading indicator, seeing a surge. So at the same time, we could also have conditions emerge to support a rally into year-end. Several measures of investor sentiment are pointing to excessive levels of fear, and we're starting to see market breadth reach oversold territory. Now, remember, there's been a lot of deterioration under the hood. While the indexes have been holding up pretty well, there's been a sizable pullback in the average stock. Well, now we're starting to get to some oversold readings. So with that in mind, this week, let's unpack signs that the economy is holding up rather well against the government shutdown, and the impact that companies are seeing and what they're talking about in their earnings reports and how they're reflecting that in their outlook for financials. And then we'll look at evidence that the market can keep climbing this wall of worry, and why one indicator why this might be the most hated bull market ever. All right, let's start with economic data. Economic data that's typically released by the various U.S. government agencies that's being delayed during the shutdown. And so we have to rely on private sector data, and private sector companies are updating their reports as usual. And so we talked about ADP earlier. ADP private sector payrolls coming in better than expected for October, showing job growth for that month. Well, a report on manufacturing and service sector activity from S&P Global is holding near the highs we've seen of the last few years. And so what this shows is S&P Global's U.S. composite PMI, so covering both the manufacturing and services sector. And these are constructed so that you got this 50 level right here. Above 50 means the economy is expanding. Below 50 points to contraction. And the composite PMI rose to 54.6 last month. That was a slight uptick from 53.9 in September. That's being driven by increasing activity in both manufacturing and services sector. So a lot of the growth recently has been in the service sector, while we're seeing manufacturing bounce back here as well. And a reading above 50 is consistent with growing annualized GDP growth. That's the gray bars on here. And you can see when this is above 50, the higher above 50, the better the GDP growth you tend to see. So this reading, again, is consistent with seeing an expanding economy. All right, estimates vary widely on the economic impact from the ongoing government shutdown. Forecasts range from $7 billion to $16 billion every single week that the shutdown persists. And there's also been a spike of mentions of the shutdown during S&P 500 earnings calls. So as we've gone through earnings season, there have been 76 companies overall mentioning the shutdown on their earnings call. That number has spiked higher, as you would expect. It is in line with mentions during the last government shutdown that happened in late 2018. But here's what's kind of interesting. Of the companies noting the shutdown, 22 of them have included an impact or potential impact on guidance for the fourth quarter or full year. So 22 companies saying they're seeing an impact and reflecting that in guidance. But at the same time, 29 companies commented that they're seeing little to no impact from the shutdown on financial results. So again, just something to consider. As the government stays shut down, we're getting a real-time look as companies are reporting earnings and what they're seeing trends in their end market. And we are seeing an uptick in companies where this is impacting financials, but there's still a large number that say that they're not seeing much of a result at least yet. So while several reports from these PMI reports, purchasing manager indexes, they cover the manufacturing and service sectors of the economy, and they have mostly been evolving pretty favorably for the outlook. But there is one problem when you look under the hood, and that is the prices paid component. The prices paid component continues to warn on inflationary pressures building ahead. And what you want to look at is the prices paid index. The prices paid measures changes in input costs that we're seeing for raw materials for services and manufacturing firms, and it continues to run at elevated levels. And in fact, the ISM Services PMI, their prices paid component jumped to 70 in the most recent report for October. You can see that is the highest level since the last inflation wave we had in late 2022. And this chart, it actually takes this prices paid component, the red line, against CPI, the white line, but it moves this 6 months forward. It moves the prices paid index 6 months forward. So you can see historically how it tends to leads key inflection points in inflation. And again, we are seeing this uptick in prices paid, which does not bode well for the inflation outlook at a time when inflation has stalled out above the 3% level for much of the past year. Here's one thing that went under the radar last week. Past week saw an updated SLOOS report, SLOOS, the Senior Loan Officer Opinion Survey that covers bank lending. It's a quarterly survey. It's conducted by the Fed, and the report gauges appetite for credit by various businesses. But not only that, but the willingness of banks to extend loans. And here's the thing you need to pay attention to. The demand for credit is continuing to expand during this cycle. And we are also hitting the highest levels we've seen since 2022. So the chart on here, what this shows is this blue line represents the net percentage of domestic banks that are seeing stronger demand for commercial and industrial loans from large and middle market firms. And so you can see this big pullback in that percentage during the last, since it was into 2023. This was the last time the Fed was tightening interest rates. So from early 2022 into early 2023, you had a sharp drop coinciding with the Fed's tightening cycle. Since then, we've started to see a recovery. You had this drop earlier this year around trade war developments, but that fog is clearing up, and you've seen this percent of firms reporting, or of banks reporting stronger demand for loans, bouncing back to the highest levels that we've seen this cycle. So loan demand hitting a new high for this cycle, that could be supported further from these recent Fed rate cuts at a time when financial conditions are already loose. So there's a saying that the market climbs a wall of worry. If that's the case, then this most recent leg of the stock market rally could be absolutely unprecedented in terms of investor fear that's out there relative to what the market is doing in terms of making gains. So despite the S&P being off just about 2.5% off the high, it's still trading above the 50-day moving average. It's been doing so for 133 consecutive sessions. But we're seeing many measures of fear ticking higher. So CNN's Fear and Greed Index recently was sitting in extreme fear territory. It's just absolutely amazing that we're barely off the highs, above the 50-day moving average, and the prevailing emotion is extreme fear. Now, at the same time, you have the AAII, their survey of retail investors. If you look back, again, during this bullish period that we've been in since June, if you look back, 11 of the past 22 weeks has seen the number of bearish outlooks among retail investors outnumber bullish outlooks. Again, that's despite the rally in the S&P 500. Now, if you look at over the average out over the full year, the spread between bulls and the bears, it's running at a minus 10.9%. So again, taking bullish views, subtracting the bears. So this means the bearish views on net have been higher than bullish views. So running at minus 10.9%. That reading has a reading that low, below 10%, has only occurred during years featuring negative S&P 500 returns. That includes 1990, the 2008 financial crisis, in 2022. And again, these were negative market years, which is when you would expect fear levels to be running high. We have fear levels running high at a time when the S&P 500 continues to rally. All right, so the ongoing rally in the stock market has left investors with concerns that we are in a valuation bubble. We are seeing extreme valuations for the S&P 500 across various metrics, two metrics that kind of take a higher level overview of what's happening with valuations. One is the cyclically adjusted PE ratio, so the Shiller CAPE ratio. This basically takes stock prices and looks at them relative to a 10-year average of earnings, so smoothing out earnings over a full cycle, where that PE stands, but then plots it against something called the Buffett indicator, named after Warren Buffett. That looks at the U.S. market cap relative to GDP. And there's a couple other bubble instances on here, or instances where the stock market saw a very sharp sell-off, either suddenly or over a prolonged period. So that includes the 1987 crash. That includes 2007 heading into 2008. You could argue that the last major valuation bubble we had was in 2000 during the internet bubble. Look at where we are now, 2025. Look at where we are now, well beyond any of those prior instances in terms of the market cap to GDP ratio, and also running at a CAPE PE ratio similar to what you had in the internet bubble. So yes, valuations are in bubble territory, but here's the thing. They can keep going as long as financial conditions stay loose, and the Fed is helping support that by cutting interest rates. And when you've had some of these prior instances come about, namely 2000, 2007, the Fed had started a tightening cycle before the bottom fell out of the stock market. So look for the same thing to happen this time around. Look for maybe building inflationary pressures to force the Fed to have to raise rates, which could be a major threat to finally ending the valuation bubble. All right, so I have a number of earnings this week. The pace of earnings reports really starts to slow down for the S&P 500. I think only 11 members of the S&P actually report this week, but we're still seeing other companies from across the market, usually with smaller cap, are still reporting. We're in the thick of earnings season, and again, the government is shut down, but these earnings reports give you a real-time look at what is happening across the economy in specific sectors. So keep an eye on earnings right here and see how, namely the outlook for forward earnings evolves, because that's what we really need at this point in the cycle to support the rally, is that you need forward earnings estimates to continue to improve given where valuations are. We just covered bubble-like valuations in a prior slide. Well, if we get those kinds of valuations, and it's the earnings growth that needs to come through to really keep driving the rally forward. So watch for how the earnings outlook evolves as these earnings reports continue to come in. One chart to keep an eye on is with ARM Holdings. So this is a semiconductor company, and chip stocks have been in the headlines, the most famous being Nvidia, but we've seen other names breaking out and building on those breakouts. So with Micron or with Advanced Micro Devices with AMD, this is the next chip maker that I would, or chip designer that I would really keep an eye on right here, and that is with ARM Holdings. And that is because this company recently going public, and after doing so in 2024, ran up near this 185, 190 area, and has been basing since then. So when you get these extended bases, what you want to start to look for is when you start to make a series of higher lows, and we're starting to see that now. So here's the test of that resistance level, but then a bigger pullback relative to what you saw before, but this was into the early April lows around the trade war, rally back. Now we're getting a lot tighter. So this pullback, much more shallower than the one before it, now gave way to another test of this 185, 190 area. Now we're seeing so far a shallower pullback relative to the last one. So those smaller pullbacks point to accumulation, which is what you want to see. We're looking for evidence that there is demand for shares, and eventually that buying pressure will overwhelm the sellers, and that will give us a breakout. And so that's what we want to look for on here. We want to see the smaller pullback hold and the stock turn back higher toward this resistance level and make a breakout on higher volume over this, call it 185 to 190 area. That is all for this